Everyone, and welcome to Forex Street webinar of 12th of January 2015. I hope that you had good holidays and nice and good New Year and start of New Year trading. So this is our first webinar in 2015, and this is the first part of Divergence webinar. So today we will see what divergence is, and next webinar will be continuation of this webinar, because you need to learn about every sort of divergence that exists in Forex world. Before we begin, as always, our standard is disclaimer. Online educational materials are developed by Nenad Kerkez Estonia for a global audience. Therefore, please take into consideration that information in this session may not be suitable for everyone. To get a corresponding information on charting conditions and any other detail, please visit www.admiralmarketsglobal.com, select your country of residence, and contact an appropriate entity. Risk disclosure statement stating all possible risks associated with Forex market. By accepting the risk, you're also proceeding further with me. Admiral Markets UK Ltd takes no responsibility for the information accuracy. The analysis represents the personal opinion of the author. It's me, and in no way it represents the actual suggestion for the trade. These are not MK's opinions, and the website in the video is not a .co.uk website, but a globalnews.com website. Forex is risky business, and this is a personal opinion only, and this webinar is for informational and educational purposes only. So with having said that, we are ready to proceed. So today, our agenda: what is divergence? Why divergence is important? Different types of divergence, how to trade it, and which divergence to trade. You're probably familiar with the divergence term in Forex trading. I will be very short with it, and I will cut to the chase immediately after I finish with this first slide. So divergence is basically when an indicator, which is usually an oscillator, and price action are in disagreement. So price action is going up and indicator is going down. So usually that is the disagreement between price action and indicator. And the thing is, when we spot that on our chart, we are sure that divergence is gonna happen. We usually use MACD for divergence. I personally use MACD in my Camarilla MACD method, and I can say for me it works the best, but I also know that other indicators also work, such as RSI, volume indicator, momentum indicator, CCI. They're also indicators which can be used in spotting divergence. The thing is, MACD being a convergence divergence indicator, for me is always and has always been working the best. So I will mostly concentrate on showing you how MACD works, and next time I will show you how stochastic and moving average work, and not moving average convergence divergence, but only moving average divergence. So if you didn't know that already, we can also trade moving average divergence, okay? And we will leave that for next time. So today it will be about MACD. Divergence, contrary to many opinions, can also be a continuation. So we will either trade a reversal or continuation. Very often, and more often than not, we trade reversal, and we take those counter trade setups when trading divergence. So I know that most of you will, maybe after this webinar, will try to trade the divergence. And I can say, if you want to trade counter trend trade, be a little bit more conservative than when you take trend trades. It's not just because you're not going with the flow. It's also because counter trend trades are definitely can be, more volatile than trend trades. In counter trend trades, once you're in the profit, and usually as soon as that profit begins to fade, definitely there is usually a continuation of the trend. Because trend, I also described the trend as a series of thrusts and pullback. So in uptrend we have thrust, then we have pullback, then we have thrust, then we have pullback, thrust and pullback. These pullbacks are counter trend opportunities. So once you spot the trend and you want to take counter trend, always have main trend in your mind, because the main trend is what defines counter trend movements. Don't forget that. So main trend is always defining counter trend movements. Uptrend is series of higher highs and higher lows. Downtrend is a series of lower highs and lower lows. What defines this trend movement is actually counter trend or so-called retracement. Now, there is obviously a big difference between retracement and reversal, and when you spot a retracement, you don't know whether it will be a pure trend retracement or maybe a reversal. So that is why I suggest trading a bit more conservative when you go counter trend than when you go with trend trades. So please be conservative, more conservative, because you are not sure whether the trend will continue or it will definitely be a reversal. More often than not, it continues in our trend direction, guys. And you see what happened to euro dollar. Unfortunately, I wasn't able to do euro dollar analysis today, but this was definitely the thing which I've spotted, and I was trying to get short, and yeah, I was trail stop today, and you can see where the trade went. The first entry was around 1830 and now it's 1810. So those, you can always be sure when you trade with a trend, you're trading with big money. And when you're trading with divergence, you're basically trading profit taking, stop grabbing, or maybe some unimportant move in counter trend direction. So always try to go with the flow, because intraday trend and should be always aligned with higher time frames. Okay, so you can, if you notice my analysis on Aussie, actually it's going right way the moment, 20-25 pips. I also published that analysis today on Forex Street, and that is trend trade, because on intraday time frame we trade with the trend. Now on higher time frames, there is actually a counter trend trade, because on higher time frames Australian dollar is bearish. On intraday time frame we are bullish, and that bullish movement basically started from divergence. So very important thing is, now we are basically now coming to the point. Divergence is important because it's an earliest indication of reversal. It's the earliest indication of reversal. So the earliest indication. You cannot know, you can guess, right? You can always guess in Forex and when you're trading Forex market. But guessing is not what we do. We want to have confirmation. So the earliest and the most obvious point of reversal is divergence. Once divergence starts to happen, we have retracement, which can turn into a full-blown reversal. So you never know whether your retracement will be a reversal or it will be pure retracement. That is why I always suggest trading it also with trail stop and trading it with having lower targets in your mind, okay? Because you don't know whether you will have retracement in the trend or a reversal in the same trend. I hope that you understand this. I'm trying to be I'm trying to give you the most simplistic explanation of divergence and trend movement. And once again, for all of you who joined a little bit later, so if you spot a trend, you know, trust pullback, you're basically trading this pullback, okay? So these pullbacks are counter trade trading. You're trading it with divergence, okay? But you don't know whether this will be a simple retracement or reversal, okay? That is why you use trailing stop when you trade counter trend, and you are always using a little bit smaller targets than when you're trading with a trend. Now, the good explanation and good example of divergence trading and counter trade trading, you can refer to my analysis of euro dollar. You can also see it on Forex Street, Forex Factory, and Admiral Markets blog. I was long at 1800 when the price was actually first touched 1800, and what happened is my target was 1.20 or 1.2060. Now I can't remember, but the thing is the price went some 50-60 pips in my direction. Then I was trail stop for some 35 pips. So the thing is, actually, when you trade divergence, you can make your target, I don't know, triple your risk, okay? But you need to use trailing stop. So after some, let's say, 1-to-1 risk to reward, you can put your stop to break even or break even plus 20, 30, 35 pips. Because counter trend is actually a counter momentum trade. And trend trade is actually when momentum is aligned on lower time frames also with higher time frames. When you're trading counter trend, you don't have that alignment, because you can see if this is 5-minute time frame, you have this counter trend opportunity. But on 1 hour, it can still be to the upside, let alone 4-hour or daily time frame. Okay, so that is why counter trend trading, if you want to trade counter trend, you need to first understand the basics of trend trading. Now, other possibility to use divergence is it's a good sign to exit a position. So let's say that you are long, and at the candle close, because divergence is always spotted on the candle close, you cannot spot or trade divergence on the leaving candle, so you need to use candle close. So when you spot candle close and you see divergence, it's a good sign to exit a position. So if you're long and you spot a regular bearish divergence, that is a good sign to exit a position, because if you're intraday trader, the price can erase your gains and actually bring you to your stop loss. So if you are intraday trader most of the time, it can also be for intra-week traders, but more often it's for intraday traders. If you spot a divergence, which is basically signaling you to reverse the trade, it's a good sign to exit the position. Okay, and we are talking about regular divergence. Regular divergence is basically counter trend. So remember that. Regular divergence is counter trend. Now, it's a good sign to scale into a position. If you spot hidden divergence, which is actually trend divergence, that can be a sign for you to add to your profitable position and make some additional profits, okay? So you have regular divergence, which is counter trend. Then you have hidden, which is trend. And you have reverse or exaggerated divergence, which is also counter trend divergence. The big merit of trading divergence is you're usually buying near the bottom or selling near the top. And that will make the risk on your trades small relative to your potential reward. Okay? Because if you go long, you want to go long and you know that the trend is to the short side, you need that very important support plus divergence to actually get you in very early, I call it early bird trade. Okay? And definitely your risk will be much smaller than when you're trading with a trend because your stops are not so big. But you need to define and you need to definitely know about important support or resistance. You cannot go when you spot divergence, you cannot go randomly. You cannot trade randomly. You spot a divergence and bam, you go long or short. No. First you need to define important levels of support and resistance, and only then you can hope that you will be trading counter trend profitably. So the first thing when you want to trade divergence is define, very important, if you're trading intraday, then obviously very important, intraday support and resistance levels. I usually follow Camarilla indicator, and I definitely love L5 and H5 levels. And when you see a divergence close to L5 or H5 or above it, you can try to trade it. So that is how I usually do. Now there are different, of course, I use also historical buyers and sellers, but that is another story. Now we are talking about divergence. So regular bullish divergence, hidden bullish divergence, regular bearish divergence, and hidden bearish divergence. Those are types of divergence we are gonna cover today. For the next time, I will prepare stochastics and moving average divergence. And addendum to these types of different types of divergence is definitely exaggerated divergence, which I will show you during this webinar. So we have standard, regular, and hidden divergence, and one more type, so-called reverse or exaggerated divergence. Hidden is trend continuation, regular is reversal type. Remember this. Boyk is asking, how can trade divergence if not use indicators? You can trade divergence by using MACD indicator. So you cannot trade divergence, Boyki, if you don't use indicators. But if you use, let's say, MACD or stochastic or even moving average or RSI, you can trade divergence. You cannot trade it without the indicator. Because the first thing you need to know is that your price and indicator are in disagreement. So you cannot trade divergence without indicators. Only with the indicator, okay? So let's start with regular bullish divergence. What did we say? What is a regular divergence? Regular divergence is the most frequent one, and it's usually considered a sign of trend reversal. As I said, you don't know whether the trend will reverse or there is just a simple retracement in the trend. But definitely it's enough for you to try to trade counter trend or to exit a position if you are going with the trend. If price is making lower lows, but the oscillator is making higher lows, this is considered to be regular bullish divergence. Now, we don't need a series of lower lows. We only need one low to be lower than the previous low. It can be found near the bottoms. I will show you later the examples, but memorize this. You only need one low to be lower than the previous low with the price and indicator. So this is the price, this is the indicator. The price has made and closed with a new low, but the indicator made a higher low. Now, the important notice for this, I personally do not recommend trading divergence on lower time frame than it's 1 hour. So below 1 hour, I don't recommend trading the divergence because divergence is most reliable on higher time frames. So for intraday trades, it's definitely good to go with 1 hour, okay? But I personally do not use it on 5 minutes or 15 minutes, okay? So usually one low is lower than the previous low. One low and one high within the price and the indicator. Hidden bullish divergence is trend following type of divergence. When price is making a higher low, but the oscillator is showing a lower low, we have hidden bullish divergence. And usually we see this when the pair is in uptrend, we see this hidden bullish divergence. And the hidden bullish divergence hints to the chart continuing to go up. So this is the price. You have basically a higher low, but the indicator is making a lower low. So also, as with regular bullish divergence, one low is more than enough to give you the divergence. So a higher low and a lower low within the price and the indicator will give you hidden bullish divergence. Now, regular bearish divergence is when the price is making a higher high, but the oscillator is making a lower high. Then you have a regular bearish divergence. So higher high on the price, but lower high on your indicator. And it can be found near the tops. So when the price is topping the chart and regular bearish divergence shows up, you will either try to go counter trend or you will exit a position if you are trading with the trend. Okay? So this is the example for regular bearish divergence. Price has made a higher high, so higher high on the price and lower high on the indicator. So higher high on the price, lower high on the indicator. Okay? That is regular bearish divergence. And we have hidden bearish divergence, as we said, with hidden bullish, with all hidden divergence. So namely, guys, all hidden divergence are trend following types of divergence. Hidden bearish divergence is when the price is making a lower high, but the oscillator is making a higher high. This can be seen when the pair is in a downtrend. Okay? This is a typo. So when the pair is in a downtrend, we usually spot hidden bearish divergence. Okay? So the price has made a lower high and the indicator has made a higher high. So you have some form of running triangle when you compare this to trend lines, and that is the sign for the charts to continue to go down with the trend direction. Okay? Now we also need to mention reverse divergence. Exaggerated or reverse divergence is a special type of divergence. Exaggerated bearish divergence can be found at the top of a larger move. Exaggerated bullish divergence can be found at the bottom of a larger move. It is similar to regular divergence. And this is definitely best to show with this slide. So when you see double top or something similar as double top on the price and lower high on the indicator, you know that there is exaggerated bearish divergence. Okay? The price will appear double topish. It looks like some sort of double top. It doesn't need to be perfect double top. It should be, it can be a little bit, you know, a few pips up and down. It doesn't matter. But it looks like it's double top. But your indicator is going down. So you have double top on the price and lower high, which is usually much lower high on the indicator. Exaggerated bullish divergence appears very close to the price bottom, and the characteristic of exaggerated bullish divergence is that the price is making a double bottomish look, but the indicator is making much higher low. Okay? Now, those are types of divergence. Now, how to trade divergence? This is the questions that many traders ask. How to trade divergence? So definitely you need to spot the divergence on the candle close, okay? On the candle close. That is the first rule to trade divergence. You need to see the candle close. If you don't see the candle close, then you obviously cannot trade divergence, because divergence will not be shown on the leaving candle. So the leaving candle cannot show you the divergence properly. You definitely need to spot the candle close, okay? Price then needs to be at important support or resistance. So if you want to take regular bullish divergence, obviously the price needs to be close to the bottom because you're going up to the upside. Regular bearish divergence, price needs to be at the top. You want to short it. How I do it? Draw a trend line or wait for the break or MACD cross if no other opposite divergence has been spotted. You definitely need to use MACD 2 line, and you need, and it's always good to find, if you roll your charts to the left, historical sellers on that same level if you're going short, or historical buyers if you're going long. Okay? This is the example for a regular bullish divergence. You can see that the price has been making a series of lower highs and lower lows, and that is definitely a downtrend. How you define a trend? You just need one confirmation. You have a high, you have a low, then you have a lower high, and you have a lower low. Even this movement here, 1, 2, 3, is basically telling you that the price is starting to make a downtrend. Okay? This is another confirmation. So basically, you should always pay attention to price zigzags. Okay? You can always draw a trend line, and very often you will spot also some form of chart pattern. And this is head and shoulders here. So when you see head and shoulders, okay, such as this one, when you see zigzag, I primarily focus myself on zigzags. So we have a high, we have a low, we have a lower high, we have lower low. That is the time to wait for and look for divergence. Now, because the price is obviously in uptrend here on 4 hour, and the price now is starting to basically make you a downtrend here, I can say, yeah, this is a regular bullish divergence. You go to the upside, but also you're going with a higher time frame, okay? Because if this is 4 hour on daily and weekly and monthly chart, the trend will usually show you still uptrend. So it's another confirmation for you to go long, okay? This is how Jaron is asking, do you only use the divergence histogram or also the lines on MACD? I use it on histogram, and I use these lines for entering the trade, okay? Boyke, I don't know what percent are all of them successful, because I don't trade every single divergence I spot. First rule for me is definitely candle close. That's easy one. But also price needs to be an important support or resistance. Okay? Definitely I need to define, it's obviously every one of us is doing that differently. I spot it I have my own levels of support and resistance coupled with Camarilla, and that is how I define important support and resistance. Now, the thing is, if you follow these things which I am telling you, you will be pretty much successful. You will be most of the time in the profit initially. But, you know, if you go for 100 pips, then you cannot hope for this. I always, because I'm mostly trading that on 1 hour time frame, I recommend after some 15 to 20 pips of a profit, I recommend using trailing stop. Now, obviously, if you're trading 25 different pairs, you know, 20, 25 pips, even though if you're stopped for 20 pips, it's still okay, because you will have definitely many chances to trade divergence. Okay? So, concentrate on this one. Let's say this is 4 hour time frame, and definitely we have a downtrend on 4 hour time frame. And you also see head and shoulders. So this is downtrend on 4 hour time frame. You want to trade divergence. You need to put a trend line, wait for the trend line break or MACD cross. Definitely in this example, we can see that MACD cross is perfectly aligned with trend line break. Okay? And now you also see that the price has been bullish pretty much. So it's still a counter trade because main trend is now on 4 hours to the downside. But you also see that there are also historical buyers here. You can see history of buyers here. You can see trend line break. And you can see, let's say that this is very important level of support. Now, what I also do is I try to align MACD cross with trend line break. And then you need to decide whether you will trade this as trigger happy trade. You know, we were talking about how to trade breakouts. So trend line breakout, you can trade with trigger happy trade, breakout retest trade, breakout pullback continuation trade. Trigger happy trade is basically entering immediately as soon as this trend line is broken. So you are zooming into 15 minutes, wait for the trend line break, and as soon as it is broken, you're entering the trade. Because MACD is confirmed the move and trend line. So that is called trigger happy trade. Then there is another possibility to trade is wait for breakout, not taking any trades, retest. This is the spot when you take the trade. As soon as the trend line is touched or it's 5 pips close to trend line, you can enter with breakout retest trade. And obviously above this point is breakout pullback continuation trade. Okay? Hidden bullish divergence. As we said, hidden bullish divergence is trend following type of divergence. You need to define a trend. We have a channel here, up channel. So this angle of this channel is sloped to the upside. So this is uptrend. And we can also see a low, a high. Then we see a higher low, and we see a higher high. So this is more than enough to define uptrend. And this is hidden divergence. You can see the price has made a higher low, and the oscillator has made a lower high. And this break of the candle can be traded. So this is trend line break. This is MACD cross. So in this example, we can see that trend line break went first, and MACD cross basically went afterwards. Breakout trigger happy trade, breakout retest trade, breakout pullback continuation trade. So you need to basically opt for one way how you will trade breakouts. And now it definitely is, that depends on your style of trading. Some people trade divergence as scalp trade, so immediately when trend line is broken and MACD has crossed up, they're entering for some 5, 10, 15 pips, and then they close the trade. I personally witness that basically retest trades and continuation trades are working. Maybe will give you definitely more pips than trigger happy trade. But if you want to go with trigger happy trade, then treat the trade as a scalping trade and protect your trade after 10 to 12 pips of a profit. Put your stop to break even, or after 15 pips of profit, put your stop to break even plus 10 or plus 12. Because trigger happy trades, as we all know it, those are risky trades, and those are trades which you definitely want to basically treat it as scalp trades, okay? But hidden bullish divergence is divergence which is telling you that the trend will continue, okay? Trend will continue when we talk about hidden bullish divergence. So if you want to take a short trade, that is a sign for you not to go short because you see hidden bullish divergence. One, as I said, one of the important merits of hidden divergence is that hidden divergence will keep you from going from going basically in a loss. So if you want to take, for example, in this trade, let's say that you want to take a short trade, but you saw a hidden bullish divergence, so you maybe won't take a long trade, but you definitely won't take a short trade. And that is what I advise. If you see hidden bullish divergence on 1 hour time frame, and you want to basically go counter trend, don't do it. Because hidden divergence will tell you this price movement will continue to go up. So don't do it, guys. Okay? You can be pretty much in a bad position if you do that, so don't do it. Okay? Now let's see regular bearish divergence. Regular bearish divergence usually appears at important tops. So this is the place where we spot divergence. So even though we can take a trade here, but you know you need to have either a trend line break or MACD cross. Now the price is still having a divergence, but you can see it made a double top. And at this point, the price has made our entry. And this is also the point where MACD crossed, okay? Okay? Now you see what I was basically talking about. You just do not enter every single time when you see divergence. You need to draw a trend line. So this was obviously a trend line here. It's a steep one, but it's still a trend line, okay? And what happened is this is the place where your trend line was broken. And this is the place where MACD crossed. And obviously this top here was more important than this top here. Okay? And you can see trigger happy trade, breakout, retest trade, and from this point breakout, pullback, continuation. Now you should apply your knowledge about trading breakouts to divergence trade, because that is how trend lines are traded. And this is also trend line, but the cause of this trend line is price action and divergence. William Blow also described that in his book. I recommend you to read it. It's called Direction Divergence by William Blow, Momentum, Direction and Divergence, and you should read it. It's a good book. So you have basically here important top, but also this is also another resistance which is important. You don't enter here because you don't have any confirmation here. The only confirmation is the price has hit the top. We have bearish divergence, but it broke the trend line here. Trigger happy trade, retest trade, continuation trade. I don't confirm divergence with higher time frames because I trade intraday, and I'm not interested to compare divergence with higher time frames because higher time frames are usually in trend direction, and I mostly trade regular divergence. So, you know, if I want to go counter trend, I usually that is the earliest sign of reversal. So if your 1 hour is like this, you want to go short because there is divergence here, okay, bearish divergence, your 4-hour or daily is still to the upside. So first you will see opposite movement in lower time frames. So you cannot confirm divergence with higher time frames. Because divergence starts to happen on lower time frames, and it eventually develops itself on higher time frames. Okay? Think logically, okay? Z. You cannot confirm divergence with higher time frames because it will start from 1 hour, then it will maybe develop to 4 hour and more. But because it's an earlier sign, the earliest sign of reversal, it's usually spotted on those lower time frames. And we have also hidden bearish divergence. You can see the price is in definite downtrend. We have high, low, lower high, lower low, lower high, lower low. But where is the trend line? We don't know where. The price has suddenly made up move, and look at this here. This is still a lower high compared to this one. Okay? And bang, it went down. Trend line break entry, divergence entry. Okay? Now the trend line break was obviously a little bit riskier because this is a drawdown here. And MACD cross was definitely better because it was a late one, but it almost had no drawdown. Now, exaggerated bullish divergence. This is definitely divergence which newbie traders will find very hard to spot. But let's see, this is very simple. This is triple bottom. Now, usually double bottom is enough, but this is triple bottom. And you can see the indicator. I recommend using MACD 2-line indicator because it's much better than standard MACD. So use MACD 2-line indicator. And you can see we have triple bottom. We have on MACD we have a higher low. And when you see this, how I trade this? Usually when I see triple bottom like this, I will enter immediately after the price crosses. Now, if I see exaggerated divergence, that is double confirmation. You cannot trade this with trend lines because you see the first most obvious trend line would happen here. So it's too far away from the price. But if you see triple or double bottom and you see exaggerated bullish divergence, you go on the candle close after a double or triple bottom. Okay? 1, 2, 3. High low. And this is the candle close. This is also the candle close. This is not wrong to go long here. And you definitely would be in profit because this is also part of this exaggerated divergence. Okay? Now, sometimes you can see a trend line. Sometimes. As in this example. You don't, this is most obvious trend line, so you cannot take trend line break. And you can see the MACD. You can trade MACD. You can trade MACD cross. Then you need to use your logic. Double bottom, important support, exaggerated divergence. You enter at the candle close, and these are rejections. So these things, wicks, are telling you that this is basically buying zone. So this zone is where buyers are. So you also will buy here. Now, this is the example when you can actually use a trend line. You have exaggerated bearish divergence. You have double top. This is double top. And this is, 39.75. This is also important level on, I think this is euro-dollar chart, as I remember. And double top at important level. Then you just draw your trend line connected to bottoms. And you can see where the price is. Break out of this, and this is actually where the candle closed, so you won't be wrong if you go short here, and you can add your shorts here. So this is how we trade the divergence. Now we need to hurry up with the webinar, and this is definitely my last slide. I have now webinar with other markets, a standard recap. Guys, this is the first step in trading divergence. Next webinar, next month, we will be talking about stochastic and moving average divergence. This webinar is being recorded, and I hope that this will be uploaded. So always refer to this webinar where you are not sure how to trade divergence. So once more for this one, double bottom, triple bottom, and you have a higher low on MACD. So at the candle close, you go with divergence, because this is where buyers are. Look at the wicks. Look at the history. Always use your logic. You cannot trade mechanically, going long, going short randomly. Use your common sense. Historical buyers, look at the history of buyers. Buyers all way down here, and you have divergence. Trend line, double top, important resistance. You can go here, you can wait for a trend line break and manage your position. So the conclusion is hidden divergence is used for trend trades. Regular divergence is used for counter trend trades. Reverse divergence is also used for counter trend trades, showing double tops, triple tops, double bottoms, triple bottoms. And watch, guys, for next webinar about MAs and stochastic divergence, which will happen next month. Okay? So thank you for listening to me. Now I need to be very fast. My next webinar starts in 10 minutes. So if you're not sure what to attend, come to Forex Recap. That is my free webinar with Admiral Markets, and I will give you different setups to make money. Okay? So thank you for listening to me. I wish you to trade safe, and I will talk with you soon. Cheers and trade safe.